but idle money may in time depreciate. Or you could spend it on a couple of nights out a week with the wife. This seems like a lot of fun. But with this kind of life, you'd depreciate. So why not put your money to work?
Put my money to work?
That's right, Mr. Finchley. You can own a share of American business. There are over 1,200 companies listed on the New York Stock Exchange. Companies which employ more than 11 million people, produce half of all the goods made in America, and pay about half the
Welcome back. We've been off for the holidays. The questions continue to roll in. Ask the Compound. On today's show, we have questions about when to cut back on a concentrated stock position as you approach your number for retirement, asset location for a trading account, IRA taxable brokerage account, big one, the pros and cons of direct indexing when changing advisors, using a margin account to avoid selling your stocks. Sounds like a rich person thing. It kind of is. How to think about tax gain harvesting. Bring our big tax expert on, as always. Remember, if you have a question for us, email the show, askthecompoundshow@gmail.com. Today's show is presented by Public. Public.com is your one-stop shop to invest in everything from stocks to bonds to options to crypto to ETFs, cash, and more. Plus, you can earn up to 6% by investing in the Public Bond account. It's really nice. I'm a big fan of simplification when it comes to portfolio management and operation of your portfolio. So it's nice to have everything in one place. You can fund your account at Public in 5 minutes or less. Remember, visit public.com/ATC. That's public.com/ATC to learn more. Duncan, I was with you yesterday in New York.
2 days ago, right?
2 days, okay.
Yeah.
I'm back home. We had a ton of questions coming over the holidays. I think people think about their finances heading into the new year.
We did. And speaking of which, is it still okay to say Happy New Year?
No.
I know you have a pet peeve about this.
According to Larry David, January 7th is the cutoff date. So
okay. Well,
no
I
more.
was going to say Happy New Year to everyone watching, but I won't now.
Can't do it. Sorry.
Okay.
Anyone in the chat who does it, take them out.
No Happy
All right.
New Year's. Got it.
Hello to everyone in the chat, everyone watching live on Twitter. Let's do this. Good questions today.
All right. Up first today, we have a question, first of 2025. We have a question from Oraldo. I'm 54, managing my own portfolio, and feel like I'm in a tough spot in terms of when to stop taking risk. I'm $115,000 away from my goal of meeting what I think is the dollar amount I would need to retire if I had to, $1.5 million. The difficult part here is that 30% of my portfolio is in Tesla. Is this too much risk? Where should I put the money if I sell?
Good question.
I love a Tesla question.
Okay.
Always fun.
Are you a Tesla holder? I don't know. I'm not sure about that.
I'm not currently, actually. I've been in and out plenty of times. Yeah.
All right. The best time to sell is right before the stock goes down, and the best time to buy is right before it goes up, right? Okay, not helpful. So Tesla is up 60% since November, and it's up, so I think, what is it? It's 27% over the last 10 years, 2,700% over the last 10 years, 1,200% over the last 5 years, and interestingly enough, only 3% or 10% over the last 3 years because it had a drawdown. John, put the drawdown chart up for me. So many massive moves. This is just the past 10 years. Tesla's had a 45% drawdown, 50%, 60%, 35%, 74%. Currently, almost like a 20% drawdown. But every single one of those are all separate crashes, and every single one of them has saw new highs. So even though you had to sit through this massive volatility, I don't know how long Araldo has held on to this for, but he's ridden some massive volatility to get there. I mean, the emotions on this one, you can do chart off, John, are very easy to predict. If you sell it and it goes down, like, guess what? You'll be happy. If you sell it and it goes up, you'll be miserable. If you hold it and it goes down, you'll be miserable. If you hold it and it goes up, you'll be happy. Like, you already know what the outcomes are going to be. So I don't think you base this decision on the outcome because you know exactly how you're going to feel behaviorally. So the way that I look at it is outperformance itself is not a financial goal. It can help you reach your financial goals, obviously, but I think selling a financial asset because it won't go up anymore, that's not like a goal thing. But are you really going to regret if you sell a portion of your assets and it helps you fund your goal? I don't think a lot of people know what their number is. To be honest, he knows what his number is. So Warren Buffett gave a speech to a group of college students at University of Maryland one year, And someone asked him, well, what's like one of the most common errors you see from wealthy people in your circles? And he said, anyone who has to become rich is dumb. Why would you risk what you need and have for what you don't need? If you are already rich, there's no upside in taking on a lot more risk, but there is disgrace in the downside. So there's this old adage that you concentrate to get rich and you diversify to stay rich, right? So obviously, he's in his 50s. If he hit his goal already, like he has to take some risk. He could have 20, 30, 40 plus years in retirement to still grow his money above the rate of inflation. So this isn't really a recommendation on Tesla one way or another. I've always said Tesla is in my too hard pile. There are people who are bullish and bearish who are very certain about what's going to happen with the stock. I've always said too hard, right? And obviously, it should have been easier, I think, with the gains that it's seen. But it hasn't been an easy company to invest in, right? So I also think it's true that these types of decisions are not like a ride at Disney, where you get on the ride, get to the end, get off the ride, right? Like, you don't have to sell it all. You could sell part of it. So I think he said it's 30% of his portfolio. So we're looking at 450% position. So what would you regret more, if it turns into 900,000 and doubles, or if it turns into 100,000 and has another 60% crash? Right? I think you kind of know what you would regret more. So I think you don't have to sell it all. Maybe just find a more reasonable size, 5%, 10%, something that is more reasonable within your portfolio. I guess my whole thing is just, why take more risk than you need to take once you've already won the game of investing and you know your number and you're there? Why try to do it twice?
Yeah, I can relate to this one because when I did actually sell my Tesla position a while back, you'd be proud. I put it into broad market ETFs. So I was just trying to de-risk my stuff a little bit.
And it's not easy to do that. And there are
and
a lot of people.
The worst thing is it's boring. It's not fun.
It is.
But,
It's boring, and people have kicked themselves for doing that. There's also other examples of companies that have just gone nowhere for years and years and years that you wish you would have sold. So I think you can look at it in both directions. I'm just a big fan of, if he's there already, why try to potentially do it again?
Yeah.
You've already won.
Yeah, that makes
All
sense.
right. One more question.
Okay. Up next, we have a question from Stefan. You talk about having a small amount of your portfolio for scratching an itch. I do this with about 5% of my total assets in a taxable account. Everything else is set it and forget investments. My rule is I do not take taxes into account in my trading decisions. It's too complicated to weigh the trade-offs and can lead to regrets, since it does not take much of a drawdown to make you wish you'd sold sooner and just paid the taxes. This year, I have pretty hefty capital gains, not to brag, and a big tax bill as a result. It's easy enough to say I don't care about taxes until I have to actually write the check. Should I shift my trading to a non-taxable account and make taxable accounts set it and forget to minimize taxes, or does that violate the sanctity of retirement accounts?
I like this question because he's kind of weighing the behavior versus the numbers. So let's bring in everyone's favorite tax guy to talk about this
Get in
one,
here, Bill.
Mr. Bill Sweet. Bill, I think I know where you probably fall on this one, I'm guessing, but I kind of like the idea. He carved out his fund portfolio, scratching the itch for 5% of it, and just said, I'm going to just go crazy here, and I don't care what the implications are, because this allows me to set it and forget it with the other stuff. But do you think he should have more of a tax-aware mindset with this kind of money?
Yeah, I landed exactly where you did. I think it's actually the right answer, right? Taxes are a secondary, tertiary concern at best. And so not thinking about the tax implications probably is a first level thought. But the thing that I think, Stefan gets to is like, is this the right answer? I mean, obviously, no, it's suboptimal, right?
Right.
To have a large bucket of tax qualified accounts. So I guess like that led me, Ben, I have two answers to this question. So number one, if you're planning on actively trading and you've demonstrated the ability to succeed, Stefan, doing that in a non-qualified account doesn't make a ton of sense, right? Because ultimately, if you're buying and selling stuff, those taxes do add to a drag. So if you have $100,000 here and $100,000 here, on one bucket you're paying tax, the other one you ain't, it should just make sense to pull the swap, right, Ben? Like just
right.
generally.
Especially if that 5% is growing and he said he's got some hefty capital gains. I've said this on a past show that I started to get way more serious about my fund account once it actually started growing in value and I saved more money in it. And I decided okay, not so much going crazy anymore. Let's actually have a coherent strategy. And I think that's kind of the place he's in right now.
Yeah, totally. And there's no reason not to use a non-qualified or taxable account for retirement purposes, right, Ben? You can set that on the same trajectory as a retirement account. It can be a long-term buy and hold. And I think that actually is a great use of those assets if you do that swap, because you're not going to be dealing with the tax drag in that case.
Right. So he could buy index funds in his taxable brokerage account.
There you go.
Then sell some index funds in one of his IRAs or 401ks or whatever and buy a bunch of stocks and go nuts with that portion.
Low-cost ETFs work. Or, Stefan, if you want to stick around, we're going to talk a little bit here about direct indexing and about what to do in retirement. But my second answer for Stefan, I think, Ben, this is a great time of year for this type of question, because if you need or want or desire to realize capital gains, I think January is a great month to do that, because that sets you up for, let's say Stefan has a $50,000 capital gain. God bless him. Not to brag. He's got 12 months or 11 and a half months now to tax loss harvest against that, right? And so if the market turns, he can pounce, he can take the assets that are elsewhere in his portfolio and then loss harvest against that. I think now's a really good time, Stefan, to be having this conversation.
Sell some of your winners in January, buy Oatly. By the end of the year, you're going to have massive losses to offset your gains. No, but I also think some people have said in the past that something like Robinhood that has taken commissions to zero, actually taking those hurdles and barriers down is a bad thing, because it lets you just go nuts. Right?
I disagree with that, though.
Sort of like gambling.
I think a lot of young
maybe
people
having
would
some
never have
barriers,
gotten in.
the taxes as a barrier, will make it so he doesn't just overtrade and go nuts in this account and potentially harm himself from behavior.
Sure.
Do you guys know how, like, in 2024, the two best portfolios that performed were Nancy Pelosi's and then reverse Kramer, right? They did whatever the opposite. Has anybody tried to do reverse Duncan? Duncan, are you aware of anti-Duncan out there?
Hey, do at your own peril. I'm just telling you. I've got some
Duncan's
good
on a
looking
heater
stuff.
Laying waste. Yeah.
out of
All
his
of
way.
his tax losses have been harvested.
I'm just telling you. I've been in RKLB for a long time, Rocket Lab. So a long time for me. 6 months to a year.
Duncan's got to talk about his winners more. Yeah, but I do like the idea of if that tax bill is finally starting to weigh on you a little bit, then do this trading strategy in another account.
I have
great
a question.
question.
I mean, in this, they do have to take into account that if you're in a retirement account instead of a trading a brokerage account, you can no longer tax loss harvest, right?
Correct.
I mean,
Duncan, I was actually going to mention that on average, most investors, when they trade, they lose, right? Just on average, right? And they trade with the market. So therefore, if you are going to trade very typically, you would want to be able to book those losses and get some economic value for them. But again, Stefan's had a good run. So let's
if you're an early 20 or 25-year-old and you're gambling, a couple $100 on options or something, I mean, there's an argument to be made that you should be doing that in a brokerage, right? I mean,
I concur.
Because I hear people making massive options trades in their Roth IRA or something, but it seems like you lose the benefit of getting to, tax loss harvest.
Yeah, I'd agree with you entirely. I think that's the right premise.
Only winners, Duncan. No losers here.
Yep, just buy the stocks that go up. That's all you have to do.
Got it.
All right, let's do another one.
Okay. Up next is a question from Dave. Hey guys, I'm a 39-year-old doctor married to another doctor, and we have a son. I was an Army doctor. She had generous parents, so we have no debt. I like how factual this beginning is.
Hey, this is an Army man here. Straight to the point.
He gets right to the point.
We work our butts off now to fire in the next few years. I want to be a Rihos client one day. If I become a client, would you be happy, neutral, or unhappy if I had a custom indexing tax loss harvesting account from another firm that was a decade old? Assuming it tracks the S&P 500, is this a sleeve one should have in their portfolio?
Dave, as always, thank you for your service. I think Bill must be bringing all the service men and women who email us constantly. They always have their stuff
we're big
together.
with the Army because of Bill.
First of all, Dave, we'd be happy to speak with you. We work with clients of all shapes and sizes. But let's go over custom indexing, Bill, because this is not something everyone is aware of. I'd say it's probably something advisors are using more than retail investors. Mm-hmm. Something we are a huge proponent of because it allows for more customization, especially from the tax side of things. But one of the downsides that people mention is you're not buying an ETF or a mutual fund that has holdings in it. You're buying each individual stock. So if you're an investor and you invest in an S&P 500 custom direct indexing account, you're buying all 500 stocks in proportion to what they are in the S&P. Do you think that transferring and moving those over is a deterrent to this type of account?
Yeah, no, not at all. Ben, Dave, I would be very happy to inherit your portfolio either now or in the future through a direct indexing model. Ben, as you know, we work with our partners at O'Shaughnessy Asset Management, Pat McStay, Ari Rosenbaum, and a great team over there with Claudine and the rest of the group. And we can easily transfer, we can easily reallocate a basket of U.S. and ex-U.S. securities and lock and load and plug that right into our models, Dave. So I think that's a great thing. But Ben, I wanted to use this opportunity maybe just to talk about a little bit what happens over 5 or 10 year periods with these types of direct indexing models. And what we've observed, Ben, since we launched our service in 2019, we're coming up on year 6 here, is that a lot of the tax loss activity is front loaded, right? As you might imagine, if you deploy a large-ish amount of cash into these models, and then you get a 2022-like year, you end up getting a lot of those losses being harvested early. And then over time, we do expect markets to appreciate, right, generally. And so what you end up seeing is the Apples, the NVIDIAs, the Netflixes, the Googles, the Microsofts, those end up becoming a larger part of your portfolio. And then your cost basis on those securities ends up being relatively low. So like, just to frame it, if you don't add money to the portfolio or take it away, you do get this tax loss benefit, but relatively early. But that, Ben, to answer Dave's question, that doesn't prevent us then from plugging into what we do best here at Ritholtz Wealth.
Right, but it's essentially that tax loss harvesting is turning into more of a deferral. So you're almost turning a taxable account into something like a IRA in some ways, in that the taxes have to be paid eventually, but you're pushing them out further and further to allow that compounding to happen without paying taxes along the way.
You're exactly correct. And you're a little bit wealthier along the way, right? Because you're reducing your current tax bill. But you're exactly right. That is a deferral, and there's only one way to get away from the deferral. And between death and taxes, I would choose taxes of the two guaranteed things in life.
Right, but the good news is, hey, we're free to take on securities, options, stocks, bonds, funds.
I would vastly prefer a basket of securities over mutual funds, ETFs. And again, there are good investment companies out there, so this is not to knock them, but it allows us to be more flexible, Ben, in our implementation.
And good luck with your goal towards firing. All right?
Kind of tangential to this, something I've heard people ask before is, can you have multiple financial advisors? Do people want to like diversify and have like some money at this firm and some money at another firm? Is that a thing?
People do like to do that, or people do want to do that, and we've found in most cases that's a mistake, because what you end up doing is playing them off of one another.
Yeah.
I remember Barry Ritholtz used to always share this story where he had a guy come to him and say, listen, I've got this pile of money. I'm going to split it up into 4 buckets. I'm going to give 1 bucket to each of you financial advisors. Whoever has the best performance after year 1 gets all the money. And you can imagine the incentive that creates,
right? Where
you tried as the advisor, I'm going to shoot the moon.
Honestly.
Yeah, and you say, I'm going to do whatever I can to have good performance.
Yeah.
If I have good performance, I'm getting all the money. If I don't have good performance, I don't care. It's not on me. It's on him. I was going to lose him anyway as a client. And so that's not everyone who uses multiple advisors, but you can see how you look at one advisor and say, why aren't you doing this? And well, why aren't you doing that? And it's not a way to run a coherent, comprehensive financial plan.
Yeah, I would agree, Duncan. I think that's my answer too, is that financial advice tends to be pretty expensive, right, in the grand scheme of things. We feel like we earn every bit that our clients are forking over, that we're invoicing our clients. And it's our job then, Ben, to go out and earn that, every year. So like if you end up splitting your portfolio, it's a lot like asking 2 different parents to raise a child. One might have a portfolio that looks a little bit like this, the other looks a little bit like this. And those two things don't always work in concert with each other, Duncan. So very generally, I would say that's probably not going to lead to good outcomes. And
in a situation like this, where our guy wants to tax loss harvest, you could be setting up some potential tax implications if one account is buying a stock that you're trying to tax loss harvest within that window, and it totally screws you up because the advisors aren't talking to each other.
Totally agree. And in the cases where we have worked it, we've been able to make it work with specific clients, but there's some friction. There just always is anytime you're working with another professional that is giving advice that might run counter to yours, right? So it's not what we would advise, Duncan, for the general population.
That makes sense.
Next question.
Okay. Up next, we have a question from Alex. We often hear about the 4% retirement rule of thumb and the 60-40 or 80-20 allocation to avoid sequence of returns risk. Wouldn't it improve our retirement to stay in a 100% stock portfolio and use a margin loan to avoid selling stocks for as long as possible?
We've gotten some questions about this over the years. It seems like a cheat code. Like, why wouldn't I just let them keep running, not have to pay the taxes? I can use the loan as my source of liquidity. I think the other part of this question here that we cut out was, he was saying, like, even if rates are higher, they're not above the historical long-term return of the stock market, I'll still be fine. Bill, what say you?
Yeah, Ben, I think that's generally it. I do actually like the premise, Alex. I like the idea here, which is how can I get creative? How can I defer on taxes? What can I do? And I would argue, Ben, that a lot of young investors, in my opinion, don't take on enough leverage. Going back 18 years of my career, I've never advised anybody paying more than the 20% down payment, and I've never advised prepaying a mortgage, because one of the few ways that an individual investor can take leverage in their portfolio is through a mortgage, through a real estate loan, right? And that's one of the few things that's available for somebody in their 20s and 30s that has a 20 or 30 or 50-year time horizon in many cases. But here's the problem with margin interest, Ben. John, can we chart on Q4 here? You're looking at best, a 10% interest rate in today's environment, right? And Ben, just we have a pretty rosy, view here of the U.S. economy. We think that things are going to be pretty good for diversified baskets of stocks, bonds, and mutual funds. But 10% to me, Ben, is at the upper limit of what I would expect from a diversified portfolio each year. So in my opinion, if you're deferring on taxes, okay, that's a benefit. But if you're paying 10% in today's economy to borrow money, that's a very, very expensive interest rate.
So we were seeing 3% rates a few years ago when rates were on the floor. And that's the other part, is that these are variable rates, right? You're not locking them in like a mortgage. What are the other downsides if your portfolio falls out of bed and you have to potentially pay the loan back?
Yep. And that would happen, Ben, if and when you get a decrease in your market value of your portfolio, right? That's when those margin calls come a-calling. And if that's the case, not only then have you paid all that interest up to that point, but in the event that you had a decrease in your market value, now, okay, great. Now you don't have any taxes to deal with, but you're taking distributions then from the portfolio ahead of a potential rebound. So I just don't think margin's the way to go. I would pursue maybe a securities-backed line of credit. I think you can get rates today in the 6.5%, 7% range. But to me, Ben, that's still too complicated. Like if you look at the U.S. 10-year Treasury rate, we're somewhere between 4.5%, somewhere around there. I wouldn't want to pay more than that to borrow, right? Because the post-tax dollar amount that you're using there just isn't worth it. And back to death and taxes, you're going to have to pay tax on this thing eventually. You're probably just going to have to bite the bullet working in your portfolio. And we're going to answer a question about that coming up next.
Right. You're paying a high margin right now, and the taxes are still going to be paid eventually. And that margin rate, loan rate, doesn't really compensate you at the moment. Correct. If you have access to cheaper credit, maybe, but not too complicated for my. There are times when we do these security-based loans or margin loans for clients in specific situations. They want to borrow against their portfolio to fund a down payment or something, but it's more of a short-term thing. It's not being used to be spent right now. This just seems too risky to me.
I was shocked when I saw those margin rates. I was expecting in the 7s, right? But even then, I think in retirement, that's the time when you probably want to be de-levering, not levering up on long duration assets.
Well said. All right, we got one more.
Okay. Last but not least, we have a question from Steven. If Bill Sweet's favorite topic is Roth accounts, I bet his second favorite is tax gain harvesting in a taxable account.
Ding.
Is that true? Okay.
For 2024, individuals with taxable income below $47,025, that last $25 really matters a lot, or $94,050 for married couples, pay 0% tax for long-term capital gains. In years when you're under the threshold, you could effectively lock in tax-free long-term gains. The idea would be to realize just enough long-term capital gains to stay within the 0% tax bracket. Can we get Bill to chime in and add some of his thoughts on this topic?
All right, Bill, do you have some napkin math on this for us? Is he right? Tax gain harvesting is your second favorite topic?
Stefan is on point, Ben, on this one. And Stefan, just wait, there's more. John, can we please chart on? One thing that Stefan forgot to add to his equation here is the standard deduction, which, Ben, this year is $15,000 for an individual tax filer, and it's $30,000 for a married couple, meaning for that amount, you do not have to pay tax until your income exceeds that threshold for the federal government. So if we adjust those numbers, I've got $63,000, almost $63,500 that you can realize in capital gains and qualified dividends, which also count for this rate, without paying any federal income tax. And yes, that is a great cheat. John, can we chart off? So planning wise, what I would think about is, okay, let's say that we stop working at some point, Ben, in our 50s, if we're, firing early, like our Army doctor friend, or maybe even our 60s, there ends up being this time period up to, like, let's say all the way up to 67, age 70, when you're not filing for Social Security benefits, you're not filing for pension, because the catch on this, Ben, is that's all of your income, right? It's not just your capital gains. Those thresholds, you need to be below that amount for your total income. So if you do have a part-time job, let's say you're still working, your spouse is working, maybe it makes a little less sense, but as a planning tool, I'm all for it. I think
right, for retirees, this is where it makes the most sense, right?
Yes. And back to question 2, why would I want to have retirement assets in non-qualified accounts? This is a brilliant reason why, right? Because if you happen to have, QQQ or SPY or just any other type of index fund that you've owned for 20 or 30 years, you probably have a lot of embedded capital gains. Realizing those tax-free is a brilliant cheat in the tax code. You need to sit down November, December and kind of do the math on where you are for income for the year. It's a little bit tricky to get there, but Ben, I think it's very possible for many investors.
So if we looked at like the average retiree's income, there's a lot of them that potentially, with some of these rules, don't pay very much in taxes at all.
Yep, correct.
Especially in those early years.
And it's one reason why a lot of folks in middle income, even higher income brackets, it makes sense to fund traditional accounts, right? I'm very pro Roth. Everybody knows that. However, one of the things that Roth math doesn't account for is this future inflation of tax brackets, right? So if my standard deduction today for a married couple is $30,000, and then I can pay $90,000 of capital gains on top of that, what is that going to be in 2035, Ben? What's it going to be in 2045, right? So like these inflation adjustments are built into the tax bracket, and very generally inflation doesn't quite keep up with the pace of market returns, but it does expand over time. And so deferring into the future does make a lot of sense for tax purposes.
And actually, I like this as a way we've talked in the past about retirees who have a hard time spending money. I think people would have a much easier time spending money and taking from their portfolio if they knew, like, I'm not paying any tax on this. Up to this level, if I take this out, it's essentially tax-free. Have at it. I'm going to spend it.
Yep, I dig it. But just, Stefan, 2 catches. I just mentioned one before. It's your total income, right? It's not just your capital gains you have to worry about for the year. But second catch is that a lot of states don't have this favorable tax bracket, right? So New York, where I live, Ben, Michigan, where you live, they do not have a favored tax rate for capital gain assets. So unless you're in Florida, Texas, or one of the other 7 states that doesn't tax income at all, that would be something to consider. It's not just the federal, but what's my state tax as well? Right.
But I guess, the big takeaway here is that maybe taxes in retirement for most people aren't as bad as they think.
I would agree.
Fair? Like, what percentage of the retiree population are we talking here?
Yeah, probably 85%. Yeah. 85%.
Really? Okay.
Yeah.
That's higher than I ever thought.
Yep. Social Security and take a look at distributions of income in the U.S. Yeah. Social Security and maybe a modest pension and some investment earnings that makes up the majority of income for
the
folks
Bill
who are
Sweet
70
presidential
and above.
tax plan. 85% of retirees will pay no taxes.
Yeah,
under my administration.
We'll see. We might see tips, off the docket here. We'll see. We'll see what happens this year, guys.
It's
going to be a wild one
as well.
Yeah. Buckle
you want
up.
to increase that SALT deduction?
Salt or die. Yeah, I think it's on the agenda here. We'll see. 2025,
right.
New year, new taxes, new rules. Let's do it.
All right, plenty of good tax questions.
Yeah.
Before we go here, we have to share some photos because Bill and I was in New York yesterday, and we had a VIP tour of the Empire State Building, which I've never done before. Bill's never done it before.
I've not.
Thanks for the invite.
Yeah, shouts to Elizabeth. Thank you.
Last minute thing, Duncan. You should have been in the office.
Yeah,
this is the kind of thing this is why you got to come to New York.
In Duncan's defense, we had no heat in the New York City office yesterday. So, like anybody who is a little sensitive, they skipped out of town and they missed it.
So you're saying it was just as warm up on the Empire State Building?
It was a little warmer once the wind started blowing. Yeah.
It was very windy. I have to say, as a tourist thing, it's one of the cooler New York City tourist things I've ever done. I've never done it before. I think, Bill, we both walked out and had the same reaction, like, oh my gosh.
Yeah, it was wild. Definitely worth it. Notice I had my daughter's stuffed animal, which got stuck in my duffel bag going down. And Ben, I want to give you credit. You made 0 dead cat bounce jokes from the 86th floor of the Empire State Building. So
a valuation joke was the only thing I had. Nosebleed valuations at 102nd floor. That's all I could do.
Did visiting it make you want to buy the stock? It's publicly traded.
I want to move the office there. Ritholtz Wealth Management. Let's do it. 86th floor.
Is it really publicly traded? I forgot that. No, I was saying it's a good short candidate because I can't imagine how much it costs to keep that building up.
I think it's ESRT or something, yeah.
Okay.
Great company.
The Empire State Building was amazing, though. Better than advertised.
And thank you, Elizabeth, for hooking us up. Appreciate it.
Yeah, lovely tour. If you have a question for us, askthecompoundshow@gmail.com. Our list is growing by the week. We might have to add an extra question in here or there because we keep getting so many good questions from people. Keep them coming. Thanks to the live chat. Thanks to everyone watching on Twitter and YouTube. Leave us a comment. Leave us a review. All that good stuff. We appreciate it. See you next time.
Thanks, everyone.